Welcome to this premium note, the professional guide to Forex Spread Mastery. I'm absolutely thrilled to be your mentor today for what is honestly a future-ready masterclass for the digital economy. If you're looking to really decode market mechanics, maybe build your own automated trading systems, and ultimately thrive as an entrepreneur or freelancer, well, you're in exactly the right place. Now, did you know that literally every single Forex trade starts at a loss? It's kind of wild to think about, right? The exact second you click buy or sell, you're immediately slightly in the red. There's this hidden gatekeeper causing that initial drop, and it's called the spread. And let me tell you, mastering exactly how this gatekeeper operates is the ultimate key to your long-term profitability and your overall business value in these digital markets. So here's a quick look at our professional syllabus for today. First, we'll decode the Forex spread and then look at how brokers actually earn their revenue. Next, we'll compare fixed versus variable spreads, choose your ideal broker infrastructure, and finish up with smart AI strategies and monetization. Okay, let's dive right into this.
Section 1. Decoding the Forex Spread, the foundational mechanics of market pricing.
Okay, to make this completely beginner-friendly, just picture this. You're a farmer selling wheat to a mill owner. They buy it from you for $200 a ton, and then they turn around and sell the flour made from that wheat for $300 a ton. That $100 difference, that's the spread. In Forex, it is the exact same concept. It just represents the gap between the ask price, which is what buyers are willing to pay, and the bid price, which is what sellers are willing to accept.
Now you might be wondering, how do we actually measure that gap? Well, we use a unit called a pip. A pip is the smallest unit of price movement in currency trading, and it usually represents the fourth decimal place, so 0.0001. So if the euro to US dollar exchange rate moves from 1.1000 to 1.1002, you're looking at a 2-pip spread.
But what does that abstract math actually mean for your wallet? Well, just think about this number for a second, $10. If you're trading a standard lot, which is 100,000 units of currency, a tiny 1-pip spread equals exactly $10. It's honestly amazing how these microscopic fractions of a penny translate directly into your real-world costs. And that's exactly why mastering this math is absolutely crucial for your wealth-building potential.
Section 2. How brokers actually earn, pulling back the curtain on industry mechanics.
You know, you've probably seen ads out there for zero-spread brokers, right? But they have to make money somehow. If they aren't adding a pip or two as a markup to the raw interbank rate, they're likely charging flat per-trade commissions or maybe overnight swap fees for holding your positions. Or they're making money through dealing desk internalization, which basically just means they're taking the other side of your trade in-house. There's always a cost structure. As a professional, you just need to know where it's hiding.
Because a spread isn't just some static, boring fee. It's actually a highly dynamic, real-time signal of market quality, and it's driven by 5 massive institutional forces: liquidity, risk, information, competition, and technology. When liquidity is high and brokers are fiercely competing for your business, those spreads compress. But the second risk and uncertainty spike in the market, boom, those spreads widen out to protect the big liquidity providers.
Section 3. Fixed versus variable spreads, choosing your battlefield.
When you're building your trading startup or mapping out a new strategy, you absolutely have to choose your pricing environment. Fixed spreads stay perfectly constant no matter how chaotic the market gets. They're incredibly predictable and usually a great fit for beginners with smaller capital, even though they do tend to be slightly higher overall. Variable spreads, on the other hand, constantly fluctuate. They get incredibly tight during peak hours, which saves you money, but they can widen significantly when major economic news drops.
Section 4. Choosing your ideal broker. Navigating market makers, STP, and ECNs.
This pricing decision directly dictates your broker infrastructure. Here, we're basically pitting the dealing desk against the non-dealing desk models. A market maker acts as your direct counterparty. They internalize your trades in-house and usually offer those predictable fixed spreads we just talked about. Conversely, ECN and STP, which stands for straight-through processing, route your orders directly out to global liquidity pools without a dealing desk, which gives you those variable spreads. One isn't inherently better than the other. It really just depends on whether your business values total predictability or access to raw, real-time market pricing.
The sheer power of that direct market access is really something. If you look at an ECN architecture flow, it's this beautifully transparent 3-step process. First, you place your order. Second, it immediately enters this massive electronic communication network pool. And third, it's instantly matched with a global liquidity provider like a major Tier 1 bank or a huge hedge fund.
So, to quickly summarize your broker options here, market makers give you fixed spreads and instant in-house execution, which is an ideal, super stable environment for beginners. STP models offer variable spreads and fast execution through an external pool, which is fantastic for intermediate traders. And ECN models give you the raw interbank spread plus a small commission, delivering the absolute fastest network matching for pro and algorithmic traders.
Section 5. Smart Strategies and AI Automation. Future-ready tactics for the digital economy.
Now, if you're planning to use rapid-fire strategies like scalping, your currency pair selection is literally everything. Look at this. The major euro to US dollar pair boasts an incredibly tiny average spread of just 0.2 pips. Minor pairs like euro to Japanese yen might sit around 0.7 pips. But look at the exotic US dollar to Mexican peso pair. That is a massive, highly volatile 27 pip spread. No way you want to get caught off guard by that. Scalpers and automated systems absolutely have to stick to those highly liquid major pairs to stay profitable.
And here is where emerging technology is just completely changing the game. High-frequency algorithms and AI-driven expert advisors absolutely thrive on those zero-spread ECN accounts we were looking at earlier. By leveraging direct API connectivity and ultra-fast virtual private servers, modern traders are successfully taking scalping from a manual, super stressful grind and turning it into a highly automated, hyper-efficient digital workflow. It's a real game changer.
Section 6. Monetization and Wealth Building. Thriving in the modern digital economy.
So the really absolutely crucial point here is, how do we actually convert all this masterclass knowledge into digital income? Well, here are some actionable paths for you as an entrepreneur. You can deploy your own automated algorithmic trading systems. You can use your deep understanding of ECNs to offer freelance broker infrastructure consulting to others. You could even dive into financial SaaS development, maybe building software that analyzes spread data. Or you could pursue professional account management. The wealth building potential here is just massive.
Which brings us to our final thought for this note. You now have the foundational blueprint to really master the spread. You understand the hidden mechanics of broker revenue, and you know how to navigate the incredibly exciting, tech-driven future of algorithmic finance. You're entirely capable, smarter, and future-ready. So the only question left for you is, how will you use this knowledge to build your digital wealth?